Okay, let's talk about the statement of financial position. I know, it sounds super formal, maybe even a little intimidating, right? But what if I told you it's basically just a company's financial selfie? Seriously, it's one single snapshot that tells you almost everything you need to know about its health at one specific moment.
In fact, how about this? What if you could figure out a company's entire net worth in, say, 60 seconds? And no, that's not a trick question. The answer lies in knowing how to read this one single, really powerful document. All right, so let's dive right in. At its heart, this financial snapshot, this selfie, is really just designed to answer three very simple questions. First, what does the company own? Second, what does it owe? And third, maybe most importantly, what's actually left over for the owners? And that brings us to its more common name, the balance sheet. It's a report that lays out a company's assets, its liabilities, and its equity. Now, the key phrase here, and you've got to remember this, is at a single moment in time. This isn't a video showing you how the company did over a year. It's a photograph. It's a snapshot taken at the close of business on one specific day. Now, here's where it gets really cool. The whole thing is held together by this incredibly elegant piece of math. It's built on one simple, unbreakable rule that makes sure a company's books are always in perfect balance. You could call it the golden rule of accounting. And here it is. Assets equals liabilities plus stockholders' equity. This isn't just a suggestion. It is a fundamental law in the accounting world. It means that everything a company owns, all of its assets, has to be equal to all the claims against those assets. And those claims, they only come from two places, from lenders, who are the liabilities, and from the owners, which is the equity. So let's break that down a bit. First up, assets. What are they? Well, they're just all the valuable stuff the company controls that's going to help it make money down the road. We're talking about the cash in its bank account, the inventory sitting in the warehouse, the computers, the trucks, the whole shebang. Next, you've got liabilities. This is pretty much the other side of the coin. It's everything the company owes to other people. Think of things like bank loans or the money it owes to suppliers for stuff it bought on credit. It's the IOU section of the report. And finally, there's equity. This one's simple, really. If you take everything the company owns, all the assets, and subtract everything it owes, all the liabilities, what's left is the equity. It's the owner's slice of the pie. It's their stake in the business. In other words, it's the company's net worth. Okay, so if that equation is a golden rule, how on earth does it stay perfectly balanced through all the chaos of a normal business day? I mean, every time something is bought or sold, it has to fit perfectly into that formula. Let's take a look at how that works. The secret is something called the dual effect. And the idea is that every single transaction, no matter how small, always affects at least two parts of that equation. It's like a self-correcting system that ensures the scales never, ever get out of whack. Let's run through a quick example. Imagine a company borrows, say, $10,000 from a bank. What happens? Well, its assets go up by 10 grand because it now has more cash. But at the exact same time, its liabilities also go up by 10 grand because it now has a loan to pay back. See? Both sides of the scale went up together. The equation is still perfectly balanced. Okay, let's do another one. This time, the company performs a service and a customer pays them in cash. So assets go up again, right? More cash in the bank. But this time, it's the other side of the equation that moves. The owner's equity goes up because that new revenue belongs to them. Once again, perfect balance. What about when money goes out? Let's say the company pays a supplier that it owed money to. In this case, its assets go down because cash just left the building. But its liabilities also go down by the exact same amount, because that debt to the supplier is now gone. Both sides decrease together. You starting to see the pattern here? All right, one last case. The company buys a bunch of inventory, but on credit. They'll pay for it later. So what happens? Its assets go up because now it has more inventory to sell, and its liabilities go up too because it now owes the supplier money. No cash has even changed hands yet, but the balance sheet reflects this new reality instantly and perfectly. So now that we've got the basic mechanics down, let's zoom in a little. Let's see how these big ideas, assets, liabilities, equity, are actually organized on a real-world balance sheet. This here is a great little roadmap. As you can see, it's not just one big list. Assets, liabilities, and equity are all broken down into more detailed categories. And this isn't random. It's all organized this way to tell a much clearer story about the company's financial health. Now, the first and probably most important split you'll see is between current and non-current. And the rule of thumb is super simple. Anything that's expected to be used up, turned into cash, or paid off within 1 year is considered current. Anything that's longer term than that is non-current. And this is absolutely crucial because it lets you see, at a glance, if a company has enough short-term cash to cover its short-term bills. So under current assets, you're going to find the stuff that's closest to cash. Obviously cash itself, but also things like receivables, that's money customers owe the company, inventories of products waiting to be sold, and even prepaid expenses, like if you paid your insurance bill for the whole year up front.
The non-current assets, well, these are the long-haul resources. This is the heavy-duty stuff. Think property, plant, and equipment, buildings, machinery, vehicles. It also includes intangible assets, which are things like patents or brand trademarks. And you'll also see any long-term investments the company might have made. And over on the liabilities side, you have current liabilities. These are the bills that are due pretty soon. This includes accounts payable, the money owed to suppliers, wages you owe your employees, and also something called unearned revenue. That's when a customer pays you for a service you haven't delivered yet. And that brings us to the equity section. It's usually broken down into a few main parts. You have the original money that investors put in, often called common stock, and then you have retained earnings. And this is a big one. This is the grand total of all the profits the company has ever made and decided to reinvest back into the business instead of paying it out to shareholders.
But listen, as powerful as this financial snapshot is, it's not a crystal ball. And to really understand what it's telling you, you have to read the fine print, so to speak, and be aware of its limitations. It's really crucial to remember a few things. First, it's just a snapshot, and things could look totally different the very next day. Second, things like buildings are usually listed at what the company paid for them ages ago, not what they're worth today. Third, there are a lot of estimates involved, like guessing how many customers won't pay their bills. And finally, some of a company's most valuable assets, like a killer brand reputation or an amazing team, don't even show up because you just can't stick a reliable dollar value on them.
Which brings us to a final thought. How does a company record buying back its own stock, what's called treasury stock? Well, the answer really reinforces our golden rule. The company has to use cash, so an asset goes down, and by buying back its own shares, the total owner's equity also goes down. An asset decreases and equity decreases by the exact same amount. The scale stays perfectly balanced. It's just a powerful reminder that behind all these complex reports is a simple, elegant logic that, once you get it, can tell you a fascinating story about pretty much any company in the world.